Hope you enjoyed chapter 4 and are ready to move on to chapter 5. So we talked about cash, which is the first thing that is on the balance sheet on the left-hand side. So if you can kind of think of this class as basically walking us down the balance sheet. So remember, when you looked at that, the first thing that appeared on there was cash. The next thing that's going to appear on there is accounts receivable. Now, why do we order them this way? We order them in what we call liquidity. So the most liquid assets, i.e. cash, is listed first, followed by the next thing that would be liquid. And in this case, in a company, it's accounts receivable. What would happen after that would be the inventory. So I haven't included marketable securities, but that's also very close to cash, because in this chapter, the basic learning objectives I'm going to cover are accounts receivable, estimated uncollectibles, how do you estimate how much is going to be uncollectible, notes receivable and how to calculate and account for the interest on those notes receivable. That would be money that we have lent out that someone is paying us back. And then how to analyze how a company is doing relative to the collection process. So obviously, the faster a company can turn over their accounts receivable, i.e. collect on their accounts receivable, then the better we consider them to be managed. Why? Because they'll get their cash sooner. Obviously, everybody would love that. All right. So I am not going to play this video, but this is a kind of a cute little video that shows a spoof of Adele on Saturday Night Live. I think it's pretty funny. I do this in my face-to-face class. But why do I bring up Adele? Well, let's think about an example that I think is pretty fitting for this chapter. So in 2015, she released her third album and then announced that she was going to go on tour. So the album shattered lots of records in terms of how fast it sold, and then the tickets for her tour sold out within just minutes. So apparently there were 10 million people trying to buy tickets, and only 750,000 of those fans were able to buy tickets. So now we have to think about when it is that we're going to recognize the revenue. So she sold 750,000 tickets. So let's say every ticket sold for $100, which is probably lowballing it these days. They're going for a lot more. So that's about $75 million that she earned from those ticket sales. But if we think about this, these are the questions we have to answer. So let's assume on the 17th of December, that's when the ticket sales were. So how much revenue has she earned on the 17th of December when the tickets actually sold and fans apparently paid cash for their tickets? So the answer is 0. So how much revenue has she earned? Well, how much singing has she done? Probably zip. So since she hasn't earned any of the revenue, where does that money go? Well, you think about it, all the fans paid the $75 million in cash or credit cards, however they paid them. It doesn't matter, because Adele looks at it all as cash. And then the money, because it hasn't been earned, would not go into revenue. It would actually go into an account called deferred revenue. And that's what we use when we haven't earned the revenue quite yet. But then let's fast forward, and on February 20th, when she plays her first concert in Nashville, then how much revenue has she earned? And in this case, then we finally are going to take some of the money out of deferred revenue and earn that revenue. So these are some of the things that we talk about in this chapter. All right. And so then what happens is we take it out of our deferred, which is a liability, and we put it into an earned revenue, which is a revenue account. So we have both an impact on the balance sheet in terms of a deferred revenue account and the income statement, because that's where revenue is found. All right, let's think about another scenario. Say in 2018, IBM provides consulting services, and they earn $11,000, but the company hasn't paid them yet. So how much revenue have they earned in 2018? And the answer is the $11,000. Now don't get confused. What I'm trying to show you here is we separate out when we actually acknowledge and recognize the revenue, and that is a separate event and separate timing perhaps on when we earn the cash. So we always have to separate those. So in IBM's case, even though they didn't get the cash, they still earned the revenue, so they're going to recognize that revenue in 2018 as a 2018 revenue, and they'll collect the cash later. So in that case, it becomes an accounts receivable for IBM. Okay, how about the next one? Well, now we're going to have a Gold's Gym membership, and let's say somebody comes in on January 1st and says, I'm going to get in shape, and here's $1,200, and that's for the entire year. Then how does Gold's Gym recognize that revenue? Well, on January 1st, when the customer hasn't even worked out yet, there's actually 0 revenue that they have earned, and they will only earn that revenue after the month of January has passed. Obviously, regardless of whether the person went or not, they still had a right to recognize that revenue on the end of January, and that would just be for $100 because that's as much revenue as they've earned. They haven't earned the whole year until the whole year is passed. Okay, then what about this other company, and they provide shipbuilding services to the Navy, and they'll be paid $150,000 at the end of each of the next 3 years beginning in 2018. So again, now we're going to match up when the revenue is earned and when and then we'll make an entry for when the cash is paid, and those so we can recognize revenue before the cash is received. So for this instance, if in fact the company has provided the services in 2018 for $450,000 and they're done and they've completed the services, even though they won't get paid until the end of the next 3 subsequent years, they still are going to recognize the $450,000 if indeed they did earn it all in 2018. Okay, then let's go to scenario 4. During 2018, Goodyear sells tires to customers on account, and by the end of the year, the collections total $30,000. At the end of 2019, it becomes apparent that the remaining $5,000 will never be collected. And that's when we're going to get into some of the other topics in this chapter about what do I do when people don't pay me and I need to write those things off. Okay, so that's what we're going to do here. So in this case, they sold the tires to the customer, so they performed the action. They either did the goods or the service or a combination of both for $35,000. So that's the revenue that gets earned, and then we'll deal with how to collect the how to acknowledge the bad debt in some of the future slides here. So I'm going to introduce you to credit sales. So credit sales are when products or services are transferred to a customer today, let's say, but the customer hasn't yet paid that. So we still will need to collect that from the customer. So this is what's called as a credit sale or a sale on account or a service on account. So don't confuse a credit sale with a credit card sale. That's a different thing. Sometimes we even call these trade sales because we're extending credit to a customer that's not on a credit card. We just offer them this as a courtesy so that they can buy the goods, but then they pay us later and we bill them later. So you and I normally are on a cash basis now, but when it comes to companies, this is sometimes how they do this. Okay. And if you'll notice off to the right, I just put a picture of what an invoice might look like. I don't know, maybe you've gotten an invoice before where you actually have to pay it. That's the idea, is that you have been extended some credit. This is a credit sale for the customer. And so we put that into what we call accounts receivable. So this is cash that is owed to the company by its customers as a result of a sale or a service that happened, quote unquote, on account. So it's recorded at the time that the sale or the service has been performed, and as I mentioned before, this could also be called a trade receivable. Okay, so how do we record that? So I'm going to give you an example here. Let's say this dentist's office called Lynx Dental charges $500 for a teeth whitening. Okay, on May 1st, DK, that's her name, get it? DK, okay, never mind, decide to have her teeth whitened, but she doesn't pay for the cash at the time of the service. Okay, so on March 31st, she promises to pay the $500 whitening fee. So this is what this would look like. So Lynx, I don't care what she does, but from Lynx dental point of view, then they would take a accounts receivable because she put it on account, she didn't actually pay it, and they also earn the revenue. So you can see that when DK had her teeth whitened was the day that Lynx Dental was able to acknowledge the service revenue. So that's what this was. Okay, even though they didn't get the cash, they still did perform the service and they are still owed that money. So this is the entry that gets made. There's a couple of details around sales that we use to get us to what's called a net sales. So there are things called sales returns and sales allowances, which are different things. So let's go into each of these. So a sales return is when a customer, obviously, they'll return the product and then they get their money back. A sales allowance is when a customer gets a discount even though they didn't return the product. Okay, so when the sales return happens, the seller issues a cash refund if it was for cash, or they put it back on their credit card. You and I have done this before. And the seller, whoever sold it, reduces their accounts receivable if the initial sale was on accounts receivable. So you walk into a place, you buy something, you put it on account, everybody's happy. You walk away with it. If you come back later and return it, then the accounts receivable that was on the books needs to be reduced because you're no longer obligated to pay that money. So that's how that works, okay? If the customer doesn't return the product, the seller issues a cash refund if it was for cash, and the seller reduces the balance in accounts receivable. So there's really no difference in the two of these. The only difference between a sales return and a sales allowance is that the customer returns their product. Okay, so they're both contra revenue accounts. Contra revenue means that it goes and sits with the gross sales on the income statement, and it serves to reduce the amount of the revenue. And then they'll get to net revenue after that. Okay, so it's called a contra account. All right, so it looks something like this. So this would be the gross sales revenue, and I just threw some numbers in here. If there's a sales discount or an allowance of some sort, that will go here and it will get you to your net revenue number. Okay? So a trade discount is a reduction in the actual price that is quoted for a product or service. A company uses a trade discount as a way to motivate people to make more purchases, obviously. Okay, so it can be a way of like putting things on sale or changing the price without actually changing the list price on this. And when a trade discount is offered and taken advantage of, then recording the transaction doesn't recognize the trade discount directly. It just does it indirectly by recording it, the sale at a discount price. All right? So in this case, if the dental company usually charged $500 for teeth whitening, but this month they decided to put it on sale and give it a 20% discount or $100, then if somebody comes in and gets their teeth whitened, then the entry would be accounts receivable for the $400 and the revenue at the $400. Notice that there was no mention of the $500 or the $20 or 20% trade discount. It just goes on the books at the trade discounted amount. So as I mentioned before, the sales allowance is a reduction in the amount of sales recognized, but the product is not returned. So in this case, after DK gets her teeth whitened, she noticed another dentist is offering the same procedure for less. So she goes back to him and says, hey, you guys, now she can't unwhiten her teeth, right? So she's not really going to give the service or the product back. But in this case, they say, okay, we will honor the lower amount, and they reduce the amount that D is responsible for by the $50 because she paid $400. She found somebody else was doing it for less, so they say, okay, well, we will reduce the amount of money that you owe us. So what does that look like? Then here we have a sales allowance, which will be a debit, and then we will take it out of DK's accounts receivable, in other words, how much she owes us, by $50. Now notice the sales allowance is a debit. That's really important because revenue is a credit. So if you're going to have a contra account to sales, it has to be the opposite balance. So in other words, it's a debit. Okay, then when the sales, when DK actually pays it off, if she was given an incentive to pay it off earlier, sometimes you see things like this as 210 net 30. What that means is that a customer is going to get a 2% discount off the total amount owed if they pay it within 10 days, but in any event, it's due and is net 30. So this could be different numbers. It doesn't always have to be 210 net 30. It could be 315 net 60 or whatever. So the 2 represents the amount of the discount. The 10 says if you pay it within this amount of days, you get this discount. If you pay it past the 10 days or the 15 days or whatever number this is, it's still due within whatever date this is. Okay? So in this case, if she's going to pay it off on May 10th, now remember she got her teeth whitened on the 1st, so she's within the discount period. So now she's going to take the sales discount of $7, which would be the $350 she owes, less 2%, which is $7. All right, so she's going to give the dentist $343. The dentist is going to recognize the $7 discount that they offered her and then take the entire amount of what she owes off of her book. So now D owes nothing to the dentist. And again, the sales discount, similar to the sales allowance, is a contra revenue account and goes and sits with the revenue account, but it reduces it so that there is a net revenue that's come up with. So here's how the final would look on the income statement. This would be what we called gross revenue. Here's the sales allowance. Remember when she wanted $50 back? And then here's when she paid it within the discount period. So this is the net revenue that Lynx Dental has made off of DK. From the balance sheet perspective, when you look at how much DK actually owed us through the accounts receivable, it started out with $400, and then it was reduced by $50 for the sales allowance, and it was reduced by another $7 with the sales discount, but we took the entire $350 off of there because that's how much was on her account that she owed. Even though she only paid us $343, we trued that up with a $7 sales discount. Okay, so how do companies really account for these customers that don't always pay us back? And we know that there are some. So we do what's called an allowance method. Now, if you think about this, the world would be a lot easier if everybody just paid cash and received cash, but we know that that's not the case. We know that credit is extended all the time, whether you're buying a house or a car, or you're a customer and you're going in and you're making a large purchase. There are always these extensions of credit that are given, but a company that extends the credit must also know that 100% of the customers will not likely pay them back. So what we need to do is set aside a certain amount of money so that we are not caught short. So we call that our bad debt expense. So the accounts receivable we don't expect to collect, then we need to reduce our assets, in other words, our accounts receivable, by the amount that we have estimated that we think we are not going to collect. And that also increases our expenses, called bad debt expense, which is simply the cost of doing business. So again, it would be nice if everybody paid once they were extended credit, but you and I know that that's not realistic. But we also know that we don't live in an all cash society. So it's just the cost of doing business, and we call that a bad debt expense. And then we also set aside some of our accounts receivable, and that's what we call an allowance account. Okay, so how do we figure out how many of the accounts that are on our books are actually going to go bad. Well, after a while, a company being operational for a while, they'll get a pretty good sense of how much of their accounts receivable will not be collected. So you can do this in what we call the balance sheet method, which is looking at the entire amount or the dollar amount of our accounts receivable and just saying X percentage, whatever that percentage is, of our accounts receivable balance, we are going to assume is not going to be collectible. Okay, so that's what we do when we're doing the percentage of receivables. It's exactly like it sounds. Just look at our accounts receivable and take a percentage of that and estimate that that amount is not going to be collected. Okay, so let's take a look at this. At the end of 2018, Lynx Dental is owed $20 million from its customers. That's a lot of teeth cleaning, huh? All right, and they estimate that 30% of it will not be collected. Now, I get lots of people asking me, well, how do they know it's 30%? Well, they don't. They take a ballpark and they look at last year's and they estimate what was uncollected last year or the year before or what's happening, how many customers actually charged. You know, there's a lot of things that go into that. For this particular class, we're not going to get too much into how did they get to that 30%. We're just going to take that amount, okay? So how much will not be collected? Well, now we're going to take the $20 million that's completely owed from all customers and multiply it times 30%. And that will be what we call our bad debt expense. Now, why is it bad debt? We don't know that those customers are not going to pay, but we're going to write off that much in expenses based on our history of how much hasn't been collected in the past. And then we're going to take our current accounts receivable balance, multiply that times that percentage. That's where we come up with the $6 million. And then the other part of that, remember an expense is a debit, so this is good. Then the allowance account is a contra account to accounts receivable, and it turns out that we're going to reduce accounts receivable by this $6 million. So if I had $20 million in sales, what I'm really saying is, yeah, I know I made $20 million in sales, but I have this inkling of this feeling that 30% of those, or $6 million of that $20 million, is not going to be collected. So to be fair, I need to represent my numbers properly and reduce my accounts receivable balance by that $6 million. Okay, so the income statement gets the bad debt, the balance sheet gets the allowance for uncollectible accounts as a contra. Okay, another possible way for us to calculate the approximation of how much in bad debt we're going to have is what we call the aging method. And the idea behind the aging method is that the longer an accounts receivable is old or has been outstanding, the less likely it is to be uncollectible or not paid. So if there's a current customer, and let's say all the current customers owe $64,500, we estimate that only 1% of those are going to be uncollectible, or $645. But then if you look down, a customer that has not yet paid us and they're 90 days past due, the chances of us seeing any of that money is slim, right? So we think about 60% of those uncollectibles are actually going to be uncollected, right? Over half of those, right? And you can see that it really jumps after a certain point. Now, again, where did we get these numbers? These numbers are going to be given to you in this class, so you don't have to worry about coming up with that percentage. But just because I know you're curious, I wanted to let you know that these are just estimates based on the customer's best projection of the uncollectibles. So looking at the income statement for Lynx Dental, we have these are their total amount of all their credit sales from all of their previous years, this year, everything, and then they're going to have a bad debt expense of $6 million. Remember, that's what we calculated. So their net sales are going to be $44 million, and that's the appropriate representation of what they really sold. Okay, so the bad debt got taken out of there. Okay, and this is just an example of Tenet Healthcare. This was published in the chapter, but you can see that a company literally on the balance sheets that they publish to the public say, we provide an allowance against accounts receivable that could be uncollected by an allowance to reduce the carrying value of such receivables. We estimate the allowance based on the aging of our accounts receivable. That's what I just showed you in the previous slide. That's called aging, and you can see that their aging is 0 to 60, 61 to 120, and they have over 180 days, and they say, you know, these people that are over 180 days, we don't think they're going to be probably collected. Okay, but I want to let you know that yes, the real world actually does this. Okay, so when it becomes clear, so at some point it's clear that some customers will just simply not pay and we have to write off their balances. So the write-off itself actually reduces the amount of accounts receivable, but it also reduces the amount of the allowance. So the allowance you can kind of think as a cookie jar that's been set aside for any suspect bad people. Well, once we realize that someone is bad, we need to take that out of that cookie jar. And we're also going to reduce the accounts receivable, since we're just basically saying, you know what, this accounts receivable is dead, not coming back, we need to just close it. Okay, so it has no effect on the total assets or the total expenses. Why? Because we already accounted for those things when we increased our bad debt, when we way back when estimated the amount of bad debt. We didn't know which people were going to be bad. Now we've identified one that is bad, but we already took the expense for that back before. Okay? So remembering what Lynx Dental actually looked like. Remember when we took that $6 million in bad debt expense, and here was our allowance account. So we actually had a credit in our allowance account for $6 million. Then on February 23rd, when we realized one who's-he what's it, Bruce, whoever his name is just a bad guy and he's not ever going to pay his bill, what we're going to do is take that $4,000 out of that cookie account called allowance for uncollectibles, because we've now identified somebody that is bad, and now we're going to also reduce the accounts receivable by that amount that Bruce actually owed us, which we're now going to say is just not going to happen. Now, let's say later Bruce comes around and he decides he wants to be, well, somewhat of a good guy, and he says, you know what, I know you wrote me off, but guess what? I'm gonna cough up some money and I'm gonna pay you a little bit of what I owe. So he says, I'm gonna give you $1,000. So on the 28th of December or September, when he comes around, then what we're gonna do, and this is kind of a two-part entry, so hold on, we're going to put the amount back into the accounts receivable account for Bruce. We're also going to put it back in the allowance account because we don't have to take that money out of that cookie jar. Then we're going to put the cash that Bruce gives us, the $1,000, in our cash account, and we're going to reduce Bruce's accounts receivable by that $1,000. Now remember, Bruce actually owed us $4,000. We're not going to put the whole $4,000 back on there. We're just going to take the money and run. We're going to put that, so this actually increases by $1,000. So before we had to decrease it by $4,000, now we're going to put $1,000 back in there. Maybe make room for somebody else. And then we're going to take the cash and reduce his accounts receivable. Okay? So this and this kind of wash each other out, but it does need to be a two-part process. Okay. Now, the aging method is obviously guessing, just like we've done. So there are times when we are going to take the balance in our accounts, and then we have to make an estimate for the following year. So we've put some money aside in our allowance account. We may have had to take some out for people that we wrote off, and then we have an ending balance, and then the end of the year comes and we kind of look forward to the next year and we say, okay, how much money do I have to put aside? So we have to take the beginning balance of what we've already accounted for from the previous year and then make that and true that up for the following year. I know that sounds complicated. I'm going to give you an example, so hold on. So the aging method estimated bad debt in 2019 to be $5 million. Actual bad debt was only $4 million, so bad debt was overestimated by $1 million. Now that's not a bad thing. That's all right. We're just going to take less bad debt when the next year comes around. So assume in 2020 our estimate is $8 million. So are we going to make a bad debt expense entry for $8 million? No, we're not. Let's find out what's going to happen. So these are all in millions, obviously, but the beginning balance for 2019 was the $5 million. We wrote off $4 million, so we still had $1 million left in before our balance. So if we estimate our new one, how do we come up with how much bad debt that we need to account for? So here's the whole picture. I started out with 5. I wrote off 4. I have $1 million balance, and so the balance before the adjustment is, and we know our new balance needs to be $8 million. So what's the adjustment need to be? And in this case, it needs to be, well, 1 plus what equals 8. 1 plus what equals 8, and it would be $7 million. So even though my bad debt is estimated to be $8 million, I actually only need to write off $7 million. Why? Because I still had a balance from last year. And this is what the entry looks like. Remember, again, we're in millions. My bad debt expense for the next year would be $7 million, and the allowance would be $7 million. All right. What happens if it's the other direction, though? What happens if I had, let's see if I can get the whole thing up here. Okay. What happens if my beginning balance was the $5 million, but instead of writing off $4 million, I actually had to write off $6 million? Well, I'm $1 million kind of in the hole, aren't I? So the next year, when it needs to be $8 million, then I need to actually make a bad debt expense entry for $9 million to make up for the balance that was there before. Okay, so in this case, here's my bad debt for $9 million and my allowance account for $9 million. So it fluctuates, and it could go either way depending on how the actuals came in against the estimate. Okay, so here's kind of how a income statement might look. Here's my revenue, here's my bad debt expense, and then there's my net income. So the reason I point this one out is because bad debt is just like any other expense, and it is directly reflected and reduces the amount of revenue to get us to our net income. From the balance sheet, we had, let's say we had a total accounts receivable of $30 million. Here's the allowance account, which brings us to a net accounts receivable balance. Now, why do we do this? We do this because what we're trying to do is represent the actual amount of accounts receivable. How much money do we think is actually going to come in from our customers? Okay, it wouldn't be proper for us to say, oh, our accounts receivable, we think we're going to get $30 million. No, not really, because we know that not 100% of the customers are actually going to pay. We need to do some of this allowance set aside. It seems kind of silly, but remember, it's just the cost of doing business. Now, there is a method called the direct write-off method, but it is not GAAP, and therefore I am not going to cover it. But that basically writes off bad debt only as it becomes apparent that that debt is going to become bad or uncollected. So they don't recognize anything, they don't set aside anything, there's no allowance account, and this is just not GAAP procedure. So again, I don't cover this. All right, so what you can do is problem 5-2 is actually in your homework, and I've just summarized it here. So record the necessary transactions for this on each of the sales, and how would they present net revenue. So on the next slide, this is my version. Your numbers will be different, but I've given you an example here of there's the journal entries that need to be made. That's how it gets represented on the income statement. So I thought that would be good practice for you. All right, this one is problem 5-4, recording transactions related to the uncollectible account. Oops. And so you can get busy on those, and I can show you, I'll actually put another slide in here on what the answers are to my version, and then you can kind of practice. But this is the aging, where they say 4% of that amount would be uncollected, Then you're going to add that to 20% of that amount plus 25 of that amount, 80% of that amount, add that total thing up. And that's what your number will be. Okay, so now, if you can figure out what this slide says, you can text me via Remind and let me know what you think this is. I'm not going to give you a hint, but it has something to do with this and something to do with this. And now we're going to move on to a completely new topic, and this one's about notes receivable. All right, so notes receivable is similar to accounts receivable. What's the difference? It's usually the duration or the length of time that a customer is going to use in order to pay us back. Okay, so a notes receivable can either be short term in the 12 months or the operating cycle, whichever is longer, or it could be long term. So it could be, over a course of years. So it depends on how long that note is going to be outstanding as to whether it's a current or a long-term asset. Okay, so this is what it's literally that I think, of course this is my own world, I think it used to be on a piece of paper, and that's why they called it a note. All right, so there would be the face value, there would be a due date, there would be a payee who it's going to get paid to. There's the interest rate, and the maker of the note is who's going to sign that saying, I owe this money. I'm making this note, handing it to this company saying, this is who I owe that money to. Okay? So when a note is received from a customer, then it goes into the notes receivable, an asset account. But if the service or the good was already given or performed, in this case it was service revenue, then they're going to recognize that revenue right away. Even though it's a note receivable, even though they may not get paid for a while, they're still going to recognize that revenue. So this happened on February 1st. Okay, and I just put down here no interest is recorded yet because no interest is recorded. Okay, so then after 6 months, the company that loaned out the money collects the entire amount from the person that owed that money, including interest. So how do we figure out our interest? We take how much of it was borrowed times the annual interest rate, which was written on the face of the note, and the fraction of the year. This was a 6-month note. This 12% is an annual rate. So had Justin in this case borrowed the money for an entire year, then it would be 12% of the $10,000, but he's really not, is he? He's only borrowing that money for 6 of the 12 months, and that's why we multiply it times the 6. Okay, so here, Kimsey, the company that lent the money, is going to take in interest revenue of $600. Again, $10,000 times 12% divided by 2. They're going to take the note receivable off of their books, and this is how much cash they're going to get from this guy, Justin, that borrowed the money. And that's a note receivable. Okay, so just to kind of line this up, you can see that depending on when the note was issued and when the month or the year end cuts off, there may need to be some entries that are made at the end of the year, even if the entire note hasn't yet been paid off. So in this case, if we create a new hypothetical, let's say they had a note that was and they have a notes receivable that started on November 1st, and it's a 6-month as well, but at the end of December they close their books. So now they're sitting there, and if they're earning interest at $100 a month for 6 months, then at the end of 2018 they're going to need to stop and say, hey, wait a minute. How much revenue have I earned for these 2 months? Now, we didn't have to do that before because in the example before, the note was taken out on February 1st. It was a 6-month, so it was all within the same fiscal year. In this case, they've taken out a note on November 1st, so there's a couple of months in 2018 that need to be recognized for the interest revenue that they've earned, and then the rest of it in 2019. And I know this sounds complicated, but I know you'll get it, okay? So there will be $200 of interest revenue in 2018, 4 months of interest revenue in 2019. So in 2018, here's the interest, and it's not cash because the customer, whoever borrowed the money from us, is not going to pay us the $200 at the end of December. They're going to pay us at the end of the loan, just like we saw before. In this case, it's a scenario. But they're not going to just stop everything they're doing and saying, oh, well, you know, you're closing your books, so I better pay you your $200 in interest. No, they're not going to do that. So the company that is loaning the money is going to put this into an interest receivable account. But check this out. They're still going to earn the revenue for $200. And they need to put this down here because literally, even though they haven't accepted the cash yet, they have still earned that revenue. Okay, and then this is the cool part. Ready for this? See, they're still going to make the $10,600 payment, but on the back end for the customer that loaned the money, then this is the amount of interest revenue. The $400 is how much has been earned in 2019. In 2018, $200 of that interest, that revenue had already been recognized up here, so I don't get to recognize it in 2019. That would be mixing my metaphors, and I don't want to do that. I got 2019. How much revenue did I make? $400. How much interest revenue did I make in 2018? $200. So this is right up here. Here's my interest revenue for 2018, but I put it into like a holding account, interest revenue, and it was a debit. So here I'm going to take it out as a credit. That's kind of why I highlighted this. Boink and boink. Those kind of reverse each other. All right. But because I had to mix my years here, now I have recognized $400 in 2019, which is correct. $200 of interest revenue in 2018, also correct. And I'm still going to get that same $10,600. You can feel free to replay that all you want. I know it's confusing at first. Okay, so now what we're going to do is kind of look at the companies and say, well, how well are you actually handling your receivables turnover? Now that is kind of a big deal because, again, what I talked about at the very beginning is the better and the faster you are at being able to collect your accounts receivable, the faster your cash comes to you. The faster your cash comes to you, the more things you can do with that cash, and frankly, the better managed you are. So we like to have a higher rather than a lower receivables turnover. Now, how do we know what's high and what's low? Because what if you took this net credit sales over the average accounts receivable, and you go, okay, I got this great number. Well, what you need to do is compare it against a similar company in a similar industry and look at their AR turnover and look at your AR turnover, and then that's where you can compare. So in the book, you're actually given two companies that are compared side by side. And I have on page 253 or thereabouts, there is a comparison of Tenet Healthcare and LifePoint Hospitals, and they show you what the receivables turnover ratio is. And for Tenet, it was 5.6. For LifePoint, it was 4.3. All things being equal, I'd rather have my AR turning over faster rather than slower. So that just gives me an indication of the two companies, okay? This is good information for creditors, for investors, and all sorts of people, okay? And then you can also see the average collection period, which is the next one. So how long does it take me to actually turn those things over? Good bellwether indicators of how well a company is being managed, how well they're collecting on their accounts receivable. Okay, oh, and here it is right here. I didn't know. Okay, so there you have it. So Tenet, as you can see, has a higher receivables turnover ratio, 6.2 versus 3.8. It probably shifts from year to year, so don't quote me exactly on these particular numbers. But then also, do they have a shorter collection period? Yes, they do. They collect in 58, almost 59 days, and LifePoint collects in 96 days. Again, I'd rather have my money collected faster rather than slower. Okay, here's a little quiz you can take just in case you'd like to test yourself, and then the following slides are all the concept checks to make sure that you got things right. So I hope this explanation helped you, and I'll see you in chapter 6.